Hello and welcome, folks, this is Boss Economics World. Today, we're taking a scalpel to the bloated carcass of Trump's tariff trade war ambitions. If you thought our economy was already teetering on a knife edge, buckle up, because the latest proposal to slap 25% tariffs on nearly all imports from Canada and Mexico, and double up on Chinese tariffs to 20%, is the next act in a tragic farce that promises to upend North American trade, revitalize protectionist fantasies, and, worst of all, jeopardize your hard-earned paycheck with skyrocketing consumer prices. Let's slice through the rhetoric and data. In just a few days, tariffs targeting roughly $1.5 trillion in annual imports are on the verge of confirmation. But don't let the bells and whistles fool you. Behind this grand show lies a series of policy misfires and economic paradoxes that threaten to send our economy into a tailspin. So, grab your analytical toolkit, we're about to break down the many layers of this drama. At first glance, President Trump's tariffs appear as a bold move to reshape the U.S. economy, tap new revenue streams, and negotiate on issues like border security, particularly on controlling the dangerous influx of fentanyl. According to administration spokesmen, these tariffs are not random acts of economic bravado, instead, they're a calculated tool of diplomatic coercion. Yet, if we peel back the rhetoric, the tariffs reveal glaring economic contradictions. For instance, while the tariffs are designed to pressure Canada and Mexico to up their game on border security, the data tells us a different story. Despite intense political drama, statistics show that only 70 pounds of fentanyl have been seized near the U.S. border since October 2021. One must ask, is this tariff maneuver really about border security or merely an economic get-rich-quick scheme dressed in political posturing? The answer, dear viewers, appears to be the latter, as these tariffs seem more like a desperate grab for revenue and a scapegoating mechanism to divert attention from the administration's economic mismanagement. Historically, tariff wars have a nasty habit of backfiring. Remember the retaliatory tariffs enacted during the previous trade clashes with China and the European Union? Those measures led to disrupted supply chains, higher consumer prices, and significant losses in export markets affecting American jobs. Recent Bloomberg data showed that U.S. manufacturing output fell by 1.8% in the quarter following earlier tariff escalations, a bitter pill for an economy already battered by a slowdown. Now, we're about to see another round of economic carnage. The shadow of these tariffs looms large over one of America's most vital economic engines, its supply chain. North American trade, particularly with Canada and Mexico, isn't just about numbers on a ledger, it's the lifeblood of industries like automotive, energy, and manufacturing. With Canada and Mexico supplying components and raw materials, a 25% tariff could turn these streamlined, efficient supply lines into bureaucratic labyrinths. Consider the auto industry. A 25% tariff on Mexican and Canadian imports isn't just a tariff, it's a wrench thrown into the well-oiled machinery of auto assembly. U.S. automakers, already squeezed by global supply chain disruptions post-COVID, might now face increased costs that will be passed directly to consumers. According to the Bureau of Economic Analysis, automotive supply chains account for over $200 billion in economic activity annually in North America. What happens when suddenly 25% is added to the price tag? It's a simple arithmetic problem: less demand, lower production, and a painful churn in the job market. More broadly, investees in industries from semiconductors to pharmaceuticals are staring down the barrel of new taxes that could compel businesses to rethink not just pricing strategies but their entire supply chain configurations. When policymakers meddle with these deeply interconnected networks, the unintended consequence is economic chaos. Recent data from the Federal Reserve showed that supply chain disruptions contributed to a 0.7% decrease in manufacturing activity in the last quarter. In less forgiving economic terms, these disruptions can stall growth and deepen recessionary pressures. The administration's mantra is clear: these tariffs will serve as revenue bricks in the foundation of new tax cuts. But here's the maddening irony. While it's true that tariffs could generate new revenue streams, some estimates predict billions for the federal coffers, they also work as a double-edged sword. In an already fragile economy, marked by falling consumer confidence and volatile markets, injecting more friction into international trade could spark inflation and further slow down growth. For example, during the previous round of tariffs, the International Monetary Fund, IMF, revised its U.S. growth forecast downward by 0.3 percentage points, warning that protectionist measures could spiral into a broader global slowdown. With consumer confidence indices already in freefall, plunging more than 5% in recent months, as reported by the University of Michigan surveys, there is no clear reason to believe that additional tariffs will serve as an economic acid reducer rather than an accelerant. Instead, consumers end up footing the bill. Higher import costs translate directly into higher prices at the gas pump, on your smartphone, or even in your local grocery store. It's plain old inflation in disguise. Not to mention the potential for retaliation. Canada's announced plans to impose retaliatory tariffs on $20.75 billion worth of U.S. goods immediately, with an additional $86.4 billion set to follow, could ultimately hurt American producers who rely on export markets. And let's be honest, folks, this isn't a win for anyone but the political pundits desperate for a headline. In a twist that sounds like a script from an economic thriller, the Trump administration is also planning a series of reciprocal tariffs. Under this scheme, countries would face charges calculated from a myriad of factors, their own tariff rates, trade barriers, even their tax regimes. While this sounds like a clever formula on paper, the real-world application is as unpredictable as trying to forecast next week's weather in a hurricane. Economists warn that the labyrinth of reciprocal tariffs could trigger a race-to-the-bottom scenario where countries escalate measures in a tit-for-tat cycle. The Trump administration hedges that, if our trading partners want to remedy what has been unfair trade, then we can see the tariffs come off. But who is to say that once the gears of retaliation are set in motion, any party will be willing, or even capable, of turning back? History, and recent experiences with trade wars, tells us that the risks of such escalating tariffs often outweigh the potential benefits. The legal complexities could invite a barrage of WTO disputes, putting decades of multilateral trade agreements on the chopping block. Adding yet another layer to this tariff stew is the plan to impose sector-specific measures. With new tariffs on steel, aluminum, autos, semiconductor chips, and even pharmaceutical drugs, not to mention a looming investigation into copper and lumber, American businesses are being hit from all sides. These industries are not isolated, they're the bedrock of American competitiveness globally. Increased costs, supply disruptions, and legal challenges are not just theoretical risks, they're a potent mix that could plunge sectors into turmoil, reminiscent of the early days of post-recession recovery when every move seemed to supply a contagion of problems. Let's not kid ourselves, this policy isn't constrained within U.S. borders. The ripples of these tariffs will extend far beyond North America. China, already reeling from the previous rounds of tariff escalations and the ongoing pandemic recovery, has weighed in, accusing the U.S. of unilateral protectionism and a violation of World Trade Organization, WTO, rules. Chinese officials have stressed that instead of piling on tariffs, the U.S. should focus on internal reforms, such as reducing domestic drug demand, a commentary that underlines how counterproductive these measures can be. On a global scale, nations are increasingly wary of protectionist measures that threaten to dismantle the very fabric of international trade. In an interconnected economy where trade accounts for nearly 60% of global GDP according to the World Bank, a breakdown in cooperation can quickly spiral into the kind of economic contraction that multidimensional studies by the OECD have warned about for decades. Countries that once traded freely now see tariffs as weapons in a political arms race, eroding the mutual benefits derived from globalization. Moreover, Canada's response is telling. Prime Minister Trudeau, even as he prepares to leave office, has declared that any U.S. tariff will be met with an unequivocal and proportional response. Already, Canadian consumers are avoiding U.S. goods, and retailers are revising their sourcing strategies ahead of potential new barriers. Through immediate retaliatory measures on a staggering $30 billion of U.S. goods, with more tariffs queued to follow, Canada is signaling that economic warfare is a two-way street. In essence, this isn't just about new tax revenues, it's a new front in a trade war that could undermine the very stability of North American economic integration. All road signs seem to indicate that we're hurtling toward a serious economic recession. Our financial markets are already jittery, stocks and cryptocurrencies have tumbled in recent months as investors brace for more shocks. Consumer confidence is in free fall, and the Federal Reserve is already on high alert for inflationary pressures. When you mix these dynamics with an aggressive tariff policy that promises to escalate into a full-blown trade war, it's not far-fetched to expect a wider sell-off in assets, increased unemployment, and a contraction in growth. Data from the U.S. Bureau of Labor Statistics shows that manufacturing employment has been particularly sensitive to supply chain shocks and tariff-induced cost hikes. The service sector, which accounts for more than 70% of U.S. employment, is now facing pressure as ancillary industries suffer from reduced export opportunities and higher input costs. Historical parallels can be drawn to the 1980s plaid rage when protectionist policies inadvertently deepened economic woes and made a strong recovery elusive. With consumer spending accounting for roughly 70% of U.S. GDP, any further erosion in confidence spells disaster for the broader economy. The irony couldn't be starker. A policy meant to shore up revenue and negotiate better terms on border enforcement is instead fanning the flames of an impending economic slowdown. It's like trying to fix a sinking ship by bailing out water with a leaky bucket. So, what's the final word on Trump's latest tariff gambit? Simply put, it's a high-stakes game of brinksmanship that risks sending the U.S. economy into deeper turmoil at a time when strategic support is desperately needed. Instead of genuinely addressing issues like border security and drug trafficking, these measures seem to be designed to distract from a broader pattern of economic mismanagement. They add layers of uncertainty, stoke inflationary pressures, and could trigger a cascade of retaliatory moves from our trading partners. The numbers don't lie. With $1.5 trillion in annual imports now hanging in the balance, North American industries and global supply chains face disruptions that could reverberate far beyond the political stage. Historical data and current market trends are issuing stern warnings. Protectionist measures of this magnitude have repeatedly led to unintended economic contractions rather than the promised fiscal gains. What we need now is not more tariffs and trade wars, but a return to pragmatic economic planning that prioritizes long-term growth, stability, and cooperation with our international partners. Policies must be driven by careful analysis and a commitment to open markets rather than impulsive political gestures. The Federal Reserve, the Treasury, and our trade negotiators would all agree that the path forward lies in multilateral dialogue and thoughtful, measured reform. As citizens and professionals invested in our economic future, it's time to demand accountability from our leaders. We deserve policies that build rather than break, that integrate rather than isolate. And while the current scene looks set for another round of tariff theatrics, know this: the economic fundamentals, robust free trade, innovation, and collaborative globalization, are not negotiable. This is Boss Economics World signing off with a reminder: when politicians choose to play games with tariffs, it's our economy, our jobs, and our future that pays the price. Let's keep our eyes wide open, question every outlandish policy move, and insist on real, sustainable economic strategies that benefit the many, not just the few. Stay tuned, stay critical, and as always, keep your economic wits sharper than any tariff.